Income tax 2020 tax software example, other itemized deductions. Come in or relax with income tax 2020. Here we are in our Lacerte tax software. You don't need the Lacerte tax software in order to follow along, although I do think they have a 30-day free trial, so if you can get access to a demo version to practice with, it might be a good tool. We're going to be focusing here on the Form 1040 and the related Schedule A, and we're going to be jumping back and forth from the data input to the tax form so we can run different scenarios, the data input or the tax software, making it easier for us to do so. We have our standard starting scenario, that being a single tax filer, Eric Smith, living in Beverly Hills 90210. We have the $100,000 in the W-2 wages, the $12,400 standard deduction to get us down to the $87,600 taxable income. If we see that in terms of the tax formula in our Excel worksheet, same layout, $100,000 income, $12,400 standard deduction, that gives us to the $87,600 taxable income. Now we're going to be looking now at itemized deductions, remembering that the itemized deductions need to be greater than the standard deduction for a single filer, that being $12,400. For a married filing joint filer, that could be $24,800. We're going to be concentrating on the other deductions, which has been severely limited, and therefore is most likely not the type of deduction that's going to push people over from not itemizing to itemizing. However, if people are close to itemizing or already itemizing, then of course any other deductions that can be taken on the Schedule A will be beneficial at that point. So we're going to go back to our software. Let's go to the Schedule A. We're looking at the bottom of the Schedule A here. We're looking at the other itemized deductions. Now notice that other itemized deductions used to be more broad, like more than 2 years ago, or basically 2 years ago or so, they adjusted the amount of items that can be included down here. So you might have people asking you questions about, more things that were possibly includable in other itemized deductions, which are no longer there. They're going to be severely limited. We went over a list of them in the prior presentation, and the one that kind of comes up fairly often, not too often, but you'll see it occasionally, is usually going to be that gambling losses. So you might see that from time to time, and it's useful to understand that. And there's two ways you kind of want to think about the gambling losses. One, if you have someone coming into they may have won something. For example, someone might have gambling winnings, and they might get something like a W-2 G that was from wherever they got the winnings from, where they had to report, because the IRS once again is going to go to the payer and pressure them to force them to report the income to the person who received it. And they're also going to give it to the IRS. So that would be a W-2G. And then they're going to say, well, can I deduct some of the losses that I had? Because probably they had losses if they had winnings. And then, and that's going to be the question. Now, of course, they're going to need the supporting documentation and so on to support the losses. But note that they can only take the losses on the Schedule A, whereas the income is going to be on the first page of the 1040 up top. And therefore, if they're not itemizing, it's not likely that the losses are going to be sufficient enough to push them over the itemizing threshold. And they're also capped by the amount of gains you have. So if you had gambling winnings, you could take losses up to the amount of the gambling winnings, but they're also going to be an itemized deduction, which you're not going to get a benefit of, even if you could take them, unless you are itemizing. So if you're talking to someone as to whether they should be collecting their losses, you're kind of thinking, okay, do you gamble a lot? Do you have losses? Do you itemize? If you itemize, then it might be worth doing. If you're talking to someone that does gamble a lot, possibly a well-off person that enjoys gambling, then they're probably going to have some winnings throughout the year just because they've done this for some time, and they'll probably have more losses, you would think, than winnings if you're going to go to traditional gambling settings, and therefore it probably might be worthwhile for them to collect or save their gambling losses, have the support for them. But once again, they would only get a benefit from them if they were able to itemize. And if you're talking about, a well-off individual that likes to gamble, then it's possibly the case that they are indeed able to itemize. And in that case, it might be worthwhile for them to take the time to save and document their gambling losses. So that's the general rule. So although we're looking at the Schedule A here, we can only deduct up to the amount of gambling winnings. So typically what will trigger this question is that you're going to get a W-2G here, a W-2G or some kind of gambling winnings that you're going to have to put on the Schedule 1 and then think about whether or not you have any losses that you could take against it. So let's do that first. We're going to say that we're on Schedule 1 and we're going to say that we had other. So I'm going to go into the other categories for gambling winnings. And then we have a W-2G. Let's take a look at the W-2G where it says we have gambling winnings. So let's say we had some gambling winnings here. And we're going to say, I'm just going to say this is a casino. We're at the casino. I had some gambling winnings of 10,000. 10,000 on the gambling winnings. And then obviously that then would pull forward to here, and you'd see it here. You'd go to the first page of the 1040. It would then pull over to the first page of the 1040, be included in the total income. Then your question is, well, maybe they have some gambling losses. So you're going to ask them about the gambling losses because there's not going to be any documentation for the gambling losses, but they might be able to take them. So if they are not itemizing, as is the case right now, they're not really close to itemizing, then, it's probably not it might not be worthwhile even going into it because, they are only going to get up to 10,000 of the losses if they have them. And oftentimes the gambling winnings, may not be that high. So it might not be worthwhile. But if they were itemizing, or if you think they're close to itemizing and they might have losses that they have documented, then you're going to say, okay, do you have any losses? And then and you'd have to, have the documentation for the losses in the event that an audit happens. So then we go down to the schedule down here, and notice I've already included them. So if I jump over, if I jump to the data input, this is one way you can get to the data input a little bit more easily. So now I'm going to go to the gambling losses, and notice I put in here 25,000 on the losses and let's just imagine they had losses greater than the income, or let's just say it was 15,000, let's say. So now you got losses greater than the amount of income you had. Well, then if I go back to the forms, it's going to cap me at the 10,000. So I can't go over the 10,000 because that's how much the income is. So it's going to cap at that point. Now, if I went below that, of course, if I said, okay, I only had losses of 8,000, then of course it's going to pick up the 8,000, the full amount of the 8,000. So it's got a cap up to the winnings. Now that, if I was to include that and look at my bottom line for the Schedule A, I'm at 9,060. That's still not enough to push me over. If I go back to the 1040 line here, I'm at 12,400 for the single filer because I'm taking the standard deduction. So notice again, the gambling winnings are probably not the type of thing that's going to push someone over to be able to itemize. What's going to push people over to itemize? Usually the house purchase, right? If they have a home and they got the mortgage on the home, so let's add that and then add the gambling winnings on top of that. So then I'd say, okay, well, let's say they got a home mortgage interest here. Home mortgage interest, which is the standard thing that, would push people over to itemizing. Let's say that's $9,000. And then we have property taxes for the home then, which is also typically included if you have a home. And let's say that's going to be $5,000. And then we're going to go back on over. And now that 8,000 here is helping us because now we're over the threshold in order to itemize, and that 8,000 is worthwhile to be doing. So again, if you're talking to someone that likes to gamble and they are over the threshold of itemizing, then you're going to say, yeah, save your gambling losses because you're going to have some winnings and you'll probably have, losses, up probably more losses in general, just given the odds and depending on most gambling situations. So you're going to want to save the losses, and that could be beneficial. So if we go then to the first page of the 1040, so that's going to pull into the 23,060, and now we're at the 86,940. Obviously, if we were married filing joint instead of single with the same information, we still wouldn't be clearing the standard deduction. Now, if I was to put this into our software over here and just kind of double check this, then typically you would have this form, the W-2G, and you'd say, I would put this in separately and say, okay, I got a W-2G for gambling winnings, and that's going to be like in the other items down here, and we said that was 10,000. And then we would ask them about the losses, which they'd have to just provide us documentation. They might not give us the documentation for it. They might actually just tell us, and we'd have to tell them you must have documentation for it in the event of an audit. and then we'd have to put in the gambling losses on the Schedule A. So Schedule A, I'm going to say miscellaneous deductions down here. So we said those were $8,000. And then, of course, we would have the 1098 for the mortgage. So I'm going to go to the interest up top and say, now I'm taking this from this tax software. We would be taking it from the 1098 in practice. And we'd say, okay, that was 9,000. So 9,000. And then possibly on the 1098, or possibly we'd have to ask them for the documentation related to the real estate taxes, property taxes, which is typically deductible if they have a home. And that we're saying was 5,000. We'd get that from the source document, not from the return again. And then the state taxes, we might be dependent on the return, or you could basically count up, the withholdings for the state. In this case, it's calculating the tax here for the sales tax. So if we calculated sales tax, I would take that from the tax software. That's something I would have to pick up from the software. If it's income tax, then you might be able to add them up from the withholdings on the W-2s and so forth. We might take a look at that in more detail in a future presentation. But then that adds up to the $23,060. So if I go back on over here, we were at $23,660, and if I roll over to the 1040 then, and now I'm going to roll back over to the first page. Now that $23,060 is over the $12,400. Therefore, we're taking the $23,060 to get our taxable income at the $86,940. Going back over here, we've got the $86,940 down here as well. So again, that if you do this separately in terms of having, the data, the source document that you're going to put into the Excel worksheet and the source document that you're going to put into the tax return, and then kind of double check this taxable income number, then you can double check, it's a good double check that you can have for the data input, at least for the first half of the tax return. And then we'll talk again about the second half of the tax calculation, which of course is the calculation of the tax credits and payments on the second page of the 1040 in future presentations.